If everyone can have their seats, we're going to get started now. Okay. Good morning, everyone. I'd like to welcome everyone to the annual Economic Revenue Consensus Forecasting Conference. My name is Robert Mujica. I am the Director of the Budget for New York State. And joining me today at the Joint Revenue Conference on the panel are Senator Liz Krueger, Chair of the Senate Finance Committee, Assemblywoman Helene Weinstein, Chair of the Assembly Ways and Means Committee, Senator James Seward, Ranking Member of the Senate Finance Committee, and Assemblyman Ed Rah, Ranking Member of the Assembly Ways and Means Committee. And then we also have Robert Ward, Deputy Comptroller. Today's conference represents the first step in what we all hope will be a smooth process towards the 10th consecutive on-time and balanced budget. Each member of this panel will have an opportunity to provide brief opening remarks. Afterwards, we'll hear testimony from a cross-section of experts who will offer their perspectives on the current economic and revenue situation. Once again, I'm proud to be participating in a process that's really dedicated to reaching consensus. Over the last 9 years, we have worked very hard together to make the New York State economy work better for all of our citizens. Working together, we have cut taxes for the middle class to the lowest level since 1947. We've enacted paid family leave. We've raised the minimum wage. We've invested in the largest infrastructure plan in the nation. We've raised school aid funding to the highest level in history, where we are now spending more per pupil than any other state in the nation. And we've expanded health care to provide health insurance for 95% of New Yorkers who are now covered. These achievements are happening in an environment of continuous economic prosperity for New York State. New York State is currently enjoying its 37th consecutive quarter of employment growth, and we have accomplished all of this while keeping state spending to below 2% over the course of this administration. Our commitment to fiscal discipline has allowed us to cut taxes, both for states' households and for businesses. And the fiscal year 21 executive budget continues these efforts by lowering taxes for small businesses, farmers, and the middle class. We have not only maintained our resolve to restrain spending at the state level, but we have also invoked our partners in all levels of state government to do the same. Again, this year, the vast majority of local governments and school districts enacted budgets within the 2% property tax cap, which was made permanent in last year's enacted budget. We look at the current state of the economy and we see several risks. The U.S. economy is expected to continue to grow, but at a slower pace. Indeed, the economic outlooks of all 5 parties here today reflect that reality. Downside risks to global growth have increased recently, mostly due to the outbreak of the coronavirus. However, on the positive side, trade policy uncertainty has subsided over the past 3 months, although it still remains elevated. Improvements in consumer fundamentals, equity market gains will support above-trend real GDP growth through most of 2020. The New York State base economy continues to perform well with steady employment gains. However, any negative developments will be amplified in the financial markets, and the impact on the revenues for New York State cannot be overstated. Our revenue outlook is based on continued growth in key areas of personal income tax receipts, premised on moderating economic growth. Capital gain realizations are the most volatile component of the personal income tax base, and those swings can be wild. The same goes for withholding related to the financial sector bonus payments, which are temporary and volatile. We need to be especially mindful of that as we navigate through this consensus process. We must also be mindful of the threat to the state's tax base due to the SALT cap itself. New York State already has the second highest tax on high income earners in the nation. Thanks to reforms made by this administration and the legislature, our current tax system is one of the most progressive in the country. Indeed, the liability share of personal income taxes for high income earners has grown from 33% in 2008 to 40% in 2020. The top 2% of taxpayers, about 188,000 filers, pay about 50% of our personal income tax base, and the top 5% pay over 60% of our personal income tax base. The increase in taxes due to SALT puts us at risk of some of these high-earning individuals of leaving New York State to a less disadvantaged state from the tax law. Losing even a small percent could hamper the progressivity of our tax code and our ability to deliver on the investments in healthcare, education, and infrastructure that New York residents have voted for again and again. Anecdotal evidence in the press already is suggesting that some high-income earners are already reconsidering where they take their income. This means raising taxes would be counterproductive towards achieving our common long-term goals. Moreover, the federal tax law continues to threaten lower home values, especially for some of our downstate counties. For many middle-class families, their homes is their most valuable asset, and a reduction in home values will make families feel less wealthy, and as a result, they will spend less. This in turn will be felt by their local community businesses and by the state in the form of lower sales taxes, real estate transfer tax receipts. Therefore, I am particularly interested in hearing the assessment of our expert panel on the following. How much of a threat is the coronavirus in the U.S. economy? Is the stock market correction likely in the near term? What is the most likely course for Fed policy over the next year? And do we need to worry about the repo markets again? What is the probability of a recession in 12 months and 2 years out? And if a recession hits within the next 2 years, where is it most likely to originate? Will domestic or external developments be the most likely culprits? My hope is that our panel of experts will be able to comment on these risks and others. Once again, we embark upon the revenue consensus process against the backdrop of substantial economic uncertainty. It is important to note, while these differences in our forecasts at a fundamental level, there is broad agreement that New York faces substantial risk given the nature of its revenue base. The types of actions proposed in the executive budget on both the revenue and the spending sides are responsible and necessary to strengthen New York's fiscal position, especially considered the additional burden placed on us by the federal government with the SALT cap. For 9 years, we have worked together to enact timely, fiscally responsible budgets that embrace the principle that state spending must grow more slowly than the overall economy. By controlling and managing spending growth, we have reduced the need to engage in overly aggressive revenue projections, and all parties deserve credit for this responsible budget making. Each of these forecasts before us today represent a good faith effort and contribution to the consensus process. I know that we are all committed to meeting the statutory March 1st deadline for reaching a consensus revenue agreement. Revenue consensus is an important component of our achieved shared goal of achieving a responsible on-time budget. Our presenters today will be Chris Varvaris from Macroeconomic Advisors by IHS Markit, Hugh Johnson from Hugh Johnson Advisors, Jason Brehm from the Federal Reserve Bank of New York, and Kajul Lahiri, University of Albany State University of New York. So at this point, I'd like to offer other members on this panel an opportunity to make opening remarks, beginning with Senator Krueger, Chair of the Senate Finance Committee.
Thank you very much, Rob. I welcome everyone to this event. And we're sitting in a relatively small room, but I've already gotten texts reminding me that people are watching and our mics are hot. Here on the panel and probably on yours. So just know if you're going to turn to each other to have a little off-the-record conversation or turn to your staff, apparently everyone will be listening. Yes, it is. I see. Helene and I learned this in weeks' worth of hearings where people would also call in or text in saying, we're hearing things perhaps you didn't want us to hear. So I just want to let everyone know we don't have ability to turn it off. So just be a little careful with that. I think Rob laid out the assignment that we need to get to an agreement on revenue. for the year so that we can continue our negotiations for income and for spending and for collecting of money in the state of New York. I have to say, I'm not sure I 100% agree with some of his analysis of what we must do or not do, but I don't know that that's my assignment for right now. I will highlight that we are the state with the greatest inequality in income, and those numbers continue to expand on both the top and the bottom, and that's something we must confront. I agree that we need to understand where we think the economy is going and help the people of New York think through what that means and what the state of New York needs to do to help them to maximize their opportunities. Something he mentioned twice, the impact of SALT. I'd be very interested in anybody's opinion. I'd asked the Tax and Finance Commissioner at the budget hearing about it, and we still apparently don't quite have the numbers of what we think the impact has been. But when I talk to people around the country, and please don't misunderstand, I don't agree with the position that the federal government took, and I am sorry that they did what they did, but I suspect we're not reversing this anytime soon, even with a different president. And so the question is, for you, how is New York going to adjust for this as a reality in our own planning and thinking? Because if the federal government, and there's been many questions like this, if the federal government's taking actions that trigger an impact here in New York State, and we don't think we can get them to reverse, what should we do, or what should we be thinking about doing to some degree change that outcome for ourselves in our favor as best as possible? And it's very difficult, but it's a continuing question, I think, for all 50 states right now, perhaps none as much as New York State. So I'm also interested in how we think a little bit out of the box of ensuring we have the money we need to run the quality programs and services which keep people wanting to move to New York, live in New York, start and run businesses in New York, have opportunities for the next generation. But we need to do that in the context of a shifting world where different revenue streams have new stories to tell. So I look forward to the materials and the presentations. Thank you, Rob.
Thank you, Senator. Assemblywoman Helene Weinstein.
Thank you. I'm pleased to be here today. I too look forward to the panelists' thoughts on the economic outlook for both the state and the nation, with a particular focus on your views about the outlook for New York state economy and the risks and uncertainty we face going forward. Over the past year, the state economy has continued to grow, and we've seen a significant increase in tax receipts. However, I'm particularly interested in hearing your assessment of the current risks to the national and state economies and how these could affect New York's fiscal outlook. Obviously, this analysis is important to us as we look to evaluate the economy and to respond as effectively as possible. And your independent viewpoints, along with today's discussion, will help to provide a solid foundation as we debate various aspects of the budget. And as others have said, a couple of issues that I'd like to get some feedback on. Again, now that we're a few years removed from the federal tax reform laws, what impacts SALT have, some of these changes SALT on, et cetera, have on the state's economy. As the budget director mentioned, the potential effect, do you believe the coronavirus would have on the national and state economy, short-term impacts, long-term impacts, in terms of SALT and what Senator Krueger said when we asked the tax commissioner if people are leaving do we have evidence of people leaving the state, particularly interested in your feelings about people who leave the state, the migration out of the state. Is it high earners or people who are of lower income who don't have find opportunities in New York State or can't afford to live here anymore? And whether it's economic conditions or taxes that help higher income earners decide whether to make decisions about remaining in the state or leaving. Some other questions I'll have later, but with that parameter, I'm very happy to listen to the comments of our distinguished panel.
Thank you, Assemblywoman. Senator James Seward.
Yeah, thank you, Budget Director Mojica and my legislative colleagues and Deputy Comptroller Ward, and as well as our distinguished panel of experts who've joined us here today. I'd like to add my words of welcome to everyone for our annual conference on the economic and revenue forecasting for our state. You know, as you all know, we're here to listen to the testimony of our invited guests on our panel in order to have that testimony help our fiscal committees and the governor's office reach a consensus forecast on the economy as well as projected revenues for our state. We're eager to hear your views on the state of the economy, Wall Street, and the state in general, and many of the moving parts that we're confronting as we do our forecasting this year have already been outlined by my colleagues. You know, personally, I believe that this conference should occur much earlier in the process, even before the executive budget is released and before our respective committees come up with a forecast to be presented. So if we had this much earlier, we would have the ability to utilize the insights of our panel as part of our forecasts. But that be set aside, the Senate Republican Finance Committee is presenting a conservative forecast in an attempt to ensure that we do not need a multi-billion-dollar re-estimate like we did last year. The Senate Republican Finance Committee projects that New York will take in $672 million more through the rest of fiscal year 2020. That's based on daily tax receipt data. In fiscal year 2021, we project that the revenues will be $41 million more than those that have been already projected by the executive. Again, I'd like to thank our members of the panel for taking the time from your busy schedules to join us here today. I look forward to the analysis and insights that we will be receiving. Thank you.
Thank you, Senator. Assemblyman Edouard.
Thank you, Budget Director Mojica. Good to be with you, Deputy Comptroller Ward, and my colleagues and our panelists this morning. I just want to highlight a couple of points that we believe in the Assembly minority are key points and things we need to be mindful of as we project our tax receipts and economic conditions. First, outmigration. You know, we know New York has lost nearly 1.4 million residents to the rest of the country since 2010, which is the largest outmigration of any state in absolute terms and second only to Alaska as a percentage of population. A continued rate of outmigration of this nature, in particular of high-income earners, may impact these economic and revenue forecasts. And it could also, as we head through the census and reapportionment, could also affect our congressional representation, which will have the impact of our influence on federal funding to our state. And despite that, though, the fear of high earners leaving the state has done little to temper the talk in this budget process of potential new taxes on supermillionaires and other luxury taxes. And I think we need to be very mindful of the volatility of our personal income tax base because of the reliance on that small group of individuals. The second, taxpayer behavior. Many of my colleagues have already referenced the changes at the federal level recently, and we know that any changes in federal or state tax law make forecasting difficult because we have to predict what people's behavior is going to be as a result of those changes. We all know taxpayers are going to look to find ways to reduce their tax liability, and this could be a significant factor going forward if there are changes at the federal level or if we do adopt any changes or new taxes at the state level. As we saw a couple years ago when we head into another presidential election, consumer and market activities are certainly going to be reacting to any changes in the Oval Office, both on positively and negatively. And the upcoming presidential election certainly could have an impact on our tax receipt forecast and economic conditions in the second half of fiscal year 2021. Consumer confidence plays a significant role in the growth of consumption tax forecasts, and any decline in consumer confidence will have a negative impact on our tax receipts. The third point is stock market. You know, we've seen all-time highs in our stock market, but we've also seen great volatility on the day-to-day basis recently due to both domestic and global concerns. A few of my colleagues have mentioned the coronavirus outbreak, and we know that that has a potential to disrupt supply chains and have an impact on the U.S. and global economy. And the fears of that, and as well as potential quarantines, will continue to have an impact on that. And as a result of that, I think we should resist the urge to over or under rely on the volatility of the market when estimating the stock market's impact on corporate profits and bonuses moving forward. With that, I'm interested in hearing from our panelists this morning, and thank you for being here and look forward to working with my colleagues as we work towards reaching a consensus.
Thank you, Assemblyman. Deputy Controller Robert Ward.
Thank you, Director Morica. Good morning, everyone. This is clearly a challenging budget year, as has been noted. Just in very recent days, we have seen newly emerging risks to the economy and the financial plan that we're still struggling to understand, and we look forward to the comments from our expert presenters to help illuminate those issues. Within this context, Controller DiNapoli continues to recommend that one priority for the state should be an ongoing commitment to building the rainy day reserves. The Division of the Budget made a $250 million deposit to the Rainy Day Reserve Fund at the end of the last fiscal year and projects a $428 million deposit at the end of the current fiscal year. These are clearly positive steps. Continuing to build these reserves further on a consistent basis would help to guard against unwanted spending cuts, tax increases, borrowing, or budgetary gimmicks the next time the state is confronted with a recession or catastrophic event. With those comments, I again join in thanking the economic experts for being with us this morning, and I look forward to your insights.
Thank you. And thank you to the panel for your opening remarks. With that, we will turn it over to the presenters. We'll start with Chris Vivaris from Macroeconomic Advisors.
Thank you very much. It's a pleasure to be here again as part of this very important process. So in the title of the slide deck is U.S. Economic Outlook Overview, Risks Are All to the Downside. Let me begin with the view of, as we like to say, from 15,000 feet. So U.S. economic growth is expected to slow from modestly above trend to modestly below trend over the next couple of years. In 2019, growth on a fourth quarter basis was 2.3%, and we expect it to come in at that or slightly below in 2020, slowing to below trend, 1.8% in 2021, and further to 1.6% in 2022. We would put trend growth, or the rate of growth of potential GDP, at around 2%. The slowing in the economy is induced by capacity constraints. We simply cannot hire workers at an ever-increasing rate, and so the rate of growth of job gains is going to slow as we go forward. In part, that's due to slowing in the rate of growth of the labor force. We have waning fiscal stimulus. So the tax cut of 2017 and the bipartisan budget acts of 2018 and 2019 boosted spending and gave the economy a little bit of a boost, and the stimulus from those three legislative actions is waning as we go forward. We do expect, under the baseline forecast, that the Fed will remove some of the accommodation it blessed the economy with last year and move to raise rates to what the Fed considers to be the medium to longer-term neutral rate. And of course, we've had slow growth abroad. With this outlook, there's some further tightening of labor markets. We'd expect to see the unemployment rate edge lower to about 3.3% by the end of the year, hang there for a while before it turns upward once growth slows below trend. We see core inflation, so consumer price inflation is measured by the Personal Consumption Expenditure Price Index, which is the Fed's preferred measure, the one that it targets, which has been running below 2% to edge up to 2% or slightly above over the next couple of years. As I noted, the Fed is now on hold, we think, until mid-2021. When I talk about coronavirus, we'll talk about how Fed policy could and likely will be impacted. Long-term yields, which have pushed recently as a result of coronavirus fears to record low levels, we would expect, if we move back to the base forecast, we'd expect those long-term yields to edge higher over the next couple of years. Equities jumped 29% last year and, of course, have given back all the gains already as a result of the coronavirus fears. Our forecast was for not much to happen with the stock market anyway, so at least in our outlook, we're not losing much by the fact that we're sort of moving sideways, since that was essentially our forecast anyway. Risk spreads, we think, will continue to narrow if we get back on the baseline forecast path. The dollar has been strong recently, and we had expected it to continue to rise as interest differentials between the U.S. and other nations continue to widen, with other nations sort of still on hold, while the U.S. would resume rate increases out in 2021. And we still think that the relatively strong dollar is probably the most likely case. Turning to the overall growth outlook and unemployment, the next chart and tables show you some of the specific numbers that we anticipate. Now, the one thing I want to highlight, because it is a source of risk before we even got to the coronavirus, was the fact that the unemployment rate, after stabilizing in the low 3% range, is expected to turn around and edge higher. In the post-war U.S. economic history, we've never had a case where the unemployment rate rose that much without there being an intervening recession. So this is something that is, we believe, possible, but it also means that recession odds begin to rise materially once you move to that period where growth slows to below trend and the unemployment rate begins to rise. There have been some special factors in the forecast. I don't want to go into a lot of detail. Just suffice it to say that the GM strike, the slowdown in production at Boeing, and then the suspension of production of the 737 MAX aircraft had the effect of taking production out of 2019 and shifting it into 2020. As a result, on a fourth quarter over fourth quarter basis, about 0.2 of GDP growth was taken away from 2019 and shifted into 2020. And as a result, the slowdown, it doesn't look quite as pronounced. We had 2.3 in 2019, we have 2.3 in 2020, but fundamentally it was really going from 2.5 to 2.1. So that's the shift due to those special factors is masking a bit the more fundamental slowing that we see. Turning to the next slide, this is the IHS Markit PMIs, which are based on surveys of corporate executives about what they expect. I'll call your attention to the far right part of this time series. The service sector PMI fell sharply in the February preliminary reading. This is probably the leading edge of the coronavirus scare and expectations amongst corporate leaders that this could get a lot worse before it gets better. The manufacturing sector, which had been weakening progressively over the last year to year and a half, seemed to have put in a bottom, and prospects there were firming, and it has sort of come off the bottom. But again, the February reading did involve somewhat of a decline, suggesting again that business leaders are reacting somewhat cautiously to what they're seeing and what they think might happen as a result of the coronavirus. Again, sticking to the base forecast, looking at slide 7, this goes through some of the major components of GDP. And here I really want to highlight the strength that we see expected to continue in consumer spending. So it's the green bars in the bar chart, and it's the third line down in the table. In the table are shown the contributions from consumer spending growth to GDP. And these have been running around just shy of 2%, and for 2020, we penciled in 1.8%. And the key here is that since consumer spending is about 2/3 of the economy, if you have above-trend growth there, it's going to provide a very solid foundation for continued solid growth overall and potentially above-trend growth for the overall economy. And the fundamentals for consumers are really quite good, and I want to talk about those in a bit. Business fixed investment, which was, it went AWOL last year, or it was on hiatus. We expect in 2020 will turn up. Part of this is due to the fact that energy prices had come up over the course of last year, and that would have prevented further decline in mining exploration related to mostly fracking, where prices $60 and above tend to be more beneficial, and they spark that type of exploration production activity. But now our revised oil price forecast is down into the low 50s, so stay tuned on the strength of that component of business fixed investment. But otherwise, we'd expect that investment will turn up this year, and that will contribute as well to GDP growth. Turning to the next chart, which shows the contribution from changes in fiscal policies at both the federal and the state and local levels to the health of GDP growth. I'll call your attention. So the gray bars here are the contribution from the federal government. The green bars or blue bars are the state and local, and the diamonds are the combined. And you can see here that as we move from 2017 to 2018, 2019, the Tax Cut and the Bipartisan Budget Acts had a fairly significant impact in contributing more in each successive year to the growth of GDP. As those effects wane, in part because the level of spending as it adjusts higher impacts growth, but once it's at that higher level, it can't continue to boost growth. It supports the level, but not the growth rate. So those effects wane and account for most of the slowing that we see in the economy as we move from 2019 into 2020. So that is a bit of a headwind that the U.S. economy faces this year in terms of not having as much support from federal and state and local spending and tax changes. Turning to the next slide, here I'll call your attention to the blue line. This is the unemployment rate, which fell from a peak of 10% at the time shortly after the end of the Great Recession, and we see declining all the way to 3.3% before it turns up. And by the end of 2022, we have it at just a little over 4%. So that's the tricky period. It's somewhere out there in the future, but when I hear about rainy day funds, I smile because they will be needed at some point in the not-too-distant future. I want to move on to the next chart. Inflation has been very tame, and we expect it to remain relatively tame. The Fed is targeting 2% inflation for the Personal Consumption Expenditure Price Index. We do like to remove the volatile food and energy components, as it's a somewhat better measure of the underlying inflation rate. And you can see the green line in this chart has been persistently below 2% over the last decade or so. And so the Fed has had some difficulty, even despite the good economy, in seeing inflation move to its target or slightly above. The Fed puts a lot of stock in having its 2% target remain credible. That's important because it helps to set the overall level of nominal interest rates. And of course, the Fed wants to have some arrows in its quiver, if you will, in the event that the economy reaches a downturn. Being able to lower nominal interest rates and lower real interest rates is the way that it's the primary way in which the Fed supports the economy when it's hit with an adverse shock. If inflation were too low, nominal rates would be lower and there would be less scope for the Fed to lower interest rates. So the credibility of that 2% target is extremely important, even to the point where there's been some discussion of raising the target perhaps to 2.5% or even 3% to give the Fed somewhat more room to lower rates in the event of a shock. But in any case, we do see a rather slow continued upward creep in inflation. The Fed, we believe, will be successful in meeting its target. And of course, it's rooting to slightly exceed that target because we believe that having been so low for such a long time, being slightly above the 2% target would reinforce 2% as the long-run average inflation rate, and that would help to maintain long-run inflation expectations. Looking at next at the wage sector, labor sector and wages, people sometimes ask us, despite the fact that the economy is in some sense beyond full employment, the unemployment rate is so low, inflation has remained amazingly calm, and so is it possible that the amount of slack or negative slack in the economy no longer influences inflation? So it's important then to look at what's been going on with wage growth. This measure of wages is hourly compensation in the non-farm business sector. It's very comprehensive. It's not simply the hourly wage. It includes all the fringe benefits, all the labor costs that get wrapped into compensation. So to include employer-paid taxes, employee-paid payroll taxes, everything that's part of compensation is wrapped into this measure. And you can see that it has come off 2%, which it fell to during the Great Recession. So it was growing around a trend of around 2%. It's moved up to a trend now of about 3.5%, and we see that continuing to rise to about 4%. So what this means is the labor component of business costs, this broad measure of hourly compensation, is moving up, growing now at a pace of about 3.5%, and to the extent that it continues to rise at this rate, it pressures margins and it encourages firms to try to pass through the added cost to prices, or offset it through productivity gains, or offset it by squeezing their suppliers to lower material costs, et cetera. But in any case, there is pressure on wage growth as a result of the tight labor markets, and we're sometimes hearing about that anecdotally, especially at the low end of the wage distribution. And while there continues to be very disparate wage median family income improvements across the income distribution, of late that has slowed a bit as a result of the fact that labor markets are this tight. Okay, turning next, so to Fed policy and the constellation of interest rates. So we do expect that the Federal Reserve will reverse course and take back those 3 insurance cuts that it made last year, but won't begin that process until mid-2021, at which point, again, if the base forecast turns out to be right, the economy will be growing just still at trend, about to transition to below trend. Inflation will be creeping up and would otherwise exceed 2% by more than the Fed would prefer, and hence that motivates the Fed to move the Fed funds rate, its target rate, to a neutral setting, which would be closer to 2.5 and 2 3/4. So that's sort of the game plan under the base forecast. With the increase expected in the Fed policy rate, we would expect to see long-term yields drift higher as well. And that's motivated by the fact that markets are currently not only not expecting the Fed to be raising rates as in our forecast, but more recently as a result of the coronavirus scare, are now expecting 1 or more rate cuts this year. So again, if we stick to the base forecast, we would expect that long-term yields would be rising as well. And that will put some upward pressure on the dollar, since those rate increases are not currently factored into the dollar pricing. So the dollar, we think, would be under some upward pressure in this environment. Okay, just want to say, so let's talk about the equity market. So on page 14, the upper left chart shows the S&P 500. You can see the rather striking gains that have been made the last couple of years, and the fact that we had the stock market going sideways for the better part of 3 years before it begins to move up again. The green line shows our estimate of the equity risk premium for the S&P 500. Of course, what's happened more recently with the coronavirus scare has been that the equity risk premium has spiked. Its impact on equity prices has been somewhat offset by the rather dramatic reductions we've seen in Treasury bill yields, the risk-free rate. But nevertheless, that risk premium has spiked, and there's a great degree of uncertainty about just how quickly that risk premium may normalize, and I'll say a little bit more about that in just a minute. The right-hand chart shows the PE ratio for the S&P 500 that is consistent with the forecast of stock prices and the overall economy that we've given you. It hangs in there around 19, which is a little high, but not unusually high for a period of continued expansion. So we're fairly comfortable that the stock market is not significantly overvalued, and that prior to the recent declines, that we would say it was approximately fairly valued. Our growth outlook was somewhat above the blue chip consensus, shown on slide 15. And this was due primarily because of the expectation that the consumer sector will continue to outperform the overall economy. So the blue chip consensus expects growth of consumer spending of about 2%, whereas we would have put it at closer to 2.6%. And the fundamentals supporting that are really quite strong. I've got a few slides that walk through that. Balance sheets are great. Debt-to-income ratios have come down. Household sector net worth has risen a striking amount over the last 10 or 12 years. If you look at the chart on slide 17, household sector net worth at the trough of the Great Recession, or immediately thereafter, was about 60 trillion. It's now at 120 trillion. So just think about that. Since 1776 to where we were in 2009, it took us that long to amass $60 trillion of household sector net worth, and we doubled it in about 10 years. So that's a huge amount of potential stimulus or support to consumer spending, that massive increase in household sector net worth. Now, I would say again, owing to the very unequal distribution, especially of equity market holdings, we would not expect that those big gains in the values of equities to translate into much additional spending as, say, some other more generic increase in wealth would be. I use the example that if Jeff Bezos wakes up tomorrow and finds out he's got $1 billion more in his Schwab portfolio, he's not going to increase his spending by 1 cent because presumably he's already spending everything he cares to. So, but nevertheless, the striking gains in household sector net worth do provide very powerful foundation for continued strong consumer spending, as well as the recent employment gains and gains in wages and salaries. So looking at slide 18, there's a chart of real, so inflation-adjusted growth in wage and salary income at the national level. So this has been growing at a very solid 3% pace on average recently, and we see that slipping only slightly over 2020 and then diminishing further as the overall economy slows and as employment gains slow. Now, it's important that at the point where the unemployment rate stabilizes and goes up, employment gains are going to drop below 100,000. All right, so those are going to be numbers that are going to resonate with people, and that's where people start to get a little spooked. And even to levels out in 2023 where we would actually potentially see employment declines month over month in a string. And that has a tendency to spook people. One of the reasons we don't see wage and salary growth slowing more is, in fact, because of the prior chart that I showed you, our expectation that hourly compensation will move higher. So the growth of hourly compensation moving up offsets somewhat the slowing in employment gains in terms of the overall impact on wage and salary income. So from the perspective of tax revenues, continued solid but slowing wage and salary growth is certainly a feature that you would want to have underlying your forecast. Okay, next I want to just, at this point, I think jump to a very important consideration about the coronavirus, because I think, well, first, sorry, talk about recession risks prior to COVID-19, as it's been called in the press, and the CDC refers to it. So let's go to slide 23. So we do have a recession probability model that's a statistical tool that we use to help gauge what the odds might be of a recession beginning within the next 12-month horizon. That model, initialized with data through January, was suggesting a probability around 4%, so negligible probability. Now, we don't put too much on this precise numbers. Generally, if you're below 25%, you can feel pretty good. If you're between 25% and 50%, you need to be concerned. And last August, this model was signaling something in the mid-30s as a probability, and that was a little bit, that sort of got our attention as it was elevated. If you're over 50%, that's a pretty solid signal, and that has been the case that every time the probability was from this model went over 50%, the economy entered a recession within the next year. So we're not there now. We did initialize this with the stock market values and Treasury yield curve inversion, all the values that are part of this model, and it increased the probability to about 25%. So that's what the model is telling us today. Now, this is only one tool that we use subjectively. If we look out over not just 1 year, but over, say, the next 3 years, to that period when growth is slowing to below trend and the unemployment rate begins to edge higher, we had put the probability of a recession at about 25%. And that was down a bit from the 35% we had seen previously. I suspect that when we complete this forecast round that is just starting today, that we will be pushing the probability of recession over that longer horizon back up to at least 35% and possibly higher, primarily as a result of what's happening with COVID-19. So I'll turn to the last slide and kind of walk through some of the things that we're seeing here. So we do view the coronavirus as a key risk to the outlook. And one of the things is we've seen the financial market impact. Financial markets can bear risk. It's in fact what they do very well. They bear risk, they price risk, that's what they do for us. What this is not risk, this is uncertainty. That is, we don't know how to price this risk. And as a result, we've seen rather dramatic declines in the prices of risky assets. So this is a shock of uncertain magnitude and duration, and it affects both the supply side and the demand side of the economy. So through its impact on supply chains, it's possible that firms will not be able to get the intermediate product or goods, materials that they need, and will be forced to shut down. When they shut down, they lay off workers have less income, and then it becomes a demand shock. And then it's also a demand shock because of the fact that people may decide they are afraid to go to the theater, or they're afraid to get on an airplane. They won't travel. And so we'll see declines in consumer spending. The question was, where will we see it? Well, it's likely that we would see it in those sorts of travel, tourism, things that people do in large groups, sporting events perhaps. People will avoid large crowds. So to the extent that we do see the epidemic spread here in the U.S., we'd expect to see a rather sharp pullback in those consumer services expenditures. So we get reduced production, factory and office closures, employees are missing. The demand shock, as I put it, will have a virus-induced agoraphobia that will impact consumer spending. So the financial shock, let's talk about that. So because of the fact that markets, when you think about how much the stock market has declined, let's just say it's 12% as a result directly of the coronavirus. All right, now remember, that's 12% that's also offset in part. It would have been bigger had we not seen the decline in interest rates, which support equity valuations. Okay, how big of a shock to the real economy would you need for earnings to basically be permanently 12% lower? Because that's what we're talking about. That's a huge shock. Okay, that's a Great Depression kind of a shock. We almost surely are not going to see that. Okay, so it tells me that to the extent that we get clarity on how bad this will be, that the financial markets will snap back rather sharply and considerably. So I wouldn't take today's valuations necessarily as a permanently lower level. I would say this is how the markets are currently responding to the huge uncertainty about this, and that we will see a snapback over time. Some of the offsets in the economy that are positive is we see lower commodity prices. So to the extent that lower oil prices and lower energy costs support real disposable income, it helps to support consumer spending. To the extent that lower interest rates can increase consumer expenditures, whether it be on durable goods or whether it be in housing, then the lower interest rates help there. And of course, with the 10-year yield setting new record lows, mortgage rates are tied to that 10-year yield. Mortgage rates are plummeting as well. We'll see a spurt of refinancing, and I think that decline in mortgage rates is an important offset to the changes in the tax code and the impact that it's had on home prices nationally, but also in New York State. So that could be a welcome positive for the state. In terms of the policy responses, I would think the financial markets, the futures markets are pricing in at least one, probably two, and as many as 3 cuts as a result of the coronavirus. And I would say that I would not argue too vociferously with that. I don't think we'll put all those cuts into our forecast when we revise this month, but I wouldn't be surprised if we put another Fed cut or 2 in as the Fed takes out additional insurance cuts against the downside risks that this virus poses. And so I think as well it's possible if we move towards a somewhat worst-case scenario, we might get a federal tax cut, perhaps something like the payroll tax holiday that we saw back in the Obama administration. Could be something that could be done that would assist and support workers. The other thing would be perhaps enhanced unemployment benefits to the extent that employment took a hit from the impact on supply chains of the virus. So I will leave it there and happy to entertain your questions either now or whenever you want to get to it.
Thank you, Mr. Viveras. Are there any questions now, or we'll go to the next one? We can always come back. Does anyone have any questions right now? No? Okay. So with that, we'll go on to Hugh Johnson. Mr. Johnson?
Mr. Budget Director, Assemblywoman or Assembly Member Weinstein, did I do that right? Roughly right? Senator Kruger, others, we really appreciate you inviting me once again to participate in this, I think, very important part of the process, and to also listen to some, I think, very capable people giving you some fairly good advice. I wouldn't want to be in your shoes. I don't believe, when I give a speech in December, and I said the one thing I could say, I've given the speech for 32 years, and I did start by saying, there's never been a time in my life, this was before coronavirus, I had no idea what coronavirus is, and I still don't, and I'm not sure we do, but I said there's never been a time in my life that or in the times that I've been speaking, that there's been a higher level of my level of discomfort was very high, and I was very concerned, or I think that it was a very uncertain period ahead for both the economy and the financial markets as we looked at 2020 and 2021. And now that we've seen the development of the coronavirus and the response in the financial markets, I wouldn't want to be in your shoes at all. I think it's an extremely, extremely difficult period to try to forecast what goes ahead. I love Chris's baseline forecast. If I had a choice, I would take that in a minute. But I think that there's a much higher level of uncertainty. And it's not so much that I disagree with you, Chris, it's just I think looking between the lines of what I think is the normal forecasting process and using some judgment, it worries me. It worries me a great deal. I think when I have what you have in the handout I've given you is a lot of numbers starting at page 6. Gives you numbers on what my, I guess you'd call it, baseline forecast is for the national economy. It gives you baseline numbers for the New York State economy. Gives you a nice, pretty chart in there which shows you that the New York State economy, as measured by the growth rate of employment, tends to track the national economy, and it looks good. I have information in there, or numbers, regarding all of the 6 states in New England. The numbers, whether measured by gross state product or employment for New York State, are really good or impressive. And when I say that, I really am looking at, you have ups and down years when employment, for example, in New York State is better than the national economy, national employment growth rates, and some years when it's worse. But if you look at all the states in New England for the 2018 to 2021 period, it sort of levels them off, and you see something that's a little bit more rational and can allow you to evaluate who's doing well and who's not doing well. And very consistently over this period of time, and I just say this almost anecdotally, I don't know if it's very helpful, it's always New York, Massachusetts, and New Hampshire. And I think it's worthwhile to note that, simply to maybe look at Massachusetts, look at New Hampshire when comparing our state to other states and trying to decide on policy. The one thing that I've sort of picked off by looking at the numbers extensively is that it's the productivity in those 3 states is significantly higher or better than you see in other states in New England. It's really it's all about productivity. I've also included in there a forecast for taxes. I wouldn't pay much attention to it, but nevertheless, you can see my forecast for taxes. These are numbers which are simply consistent with the forecast for the national economy and the state economy. Whether they're right or wrong, or whether they're a good forecast or not, remains to be seen. I think you can probably do a more nuanced and better job of forecasting taxes through, I think I have it through the fiscal year 2022. But they're very consistent with the general forecast. What I always like to do is is like to look at and ask myself the question, how do things look at the year ahead? And the first thing I look at is the performance of the financial markets. There's no question that this is a difficult year, in part because we're at the 130-month mark of this bull market. We're at the 127-month mark of the economic expansion. This is the longest bull market and the longest economic expansion since 1890 or in our history. That alone tells you that you need to be a little bit worried or concerned about what lies ahead in 2020 and 2021. I also look at the performance of the financial markets and ask myself the question, what are the financial markets telling me? What are investors collectively? Investors collectively, and I say this very emphatically, tend to get it right. When I get difficult questions like who's going to win the election or what's going to be the impact of coronavirus, I don't know the answer, but I think that the performance of the financial markets collectively, and I say this importantly, the performance of the financial markets collectively probably gives you the right answer or the extent to which you should take it seriously or not. If you look at the performance of the financial markets and leave out the last week or so, or last 5 or 6 days, and you really have to do that, you get a picture that's very consistent. I think not entirely consistent with Chris's baseline forecast, but consistent certainly with my baseline forecast, and a fairly reasonable outcome. The real question being, is this going to be a hard landing year, a bear market with a recession, or is it going to be a soft landing year? I think the case for a hard landing is a really good case. It's not the financial markets are on balance, I think, performing in a way that's positive or consistent with economic expansion. But there's some exceptions now, some exceptions showing up. And I'm leaving out the last 4 or 5 days. There's some exceptions. You see utility stocks performing well. That's not a good sign. You see large capitalization stocks outperforming small, mid and small capitalization stocks. Investors being less willing to take risk. That's not a good sign. And you see interest rates, of course, coming down. They don't come down when you have an economic expansion. So there's some signs from the financial markets which are not particularly encouraging. My biggest problem is I have to look at the last 5 or 6 days. I could give you the numbers, but you don't need to be given the numbers. The numbers are overwhelmingly negative. Whether you look at sector performance, capitalization performance, performance of value stocks versus growth stocks, performance of interest rates, the performance of the yield curve, the performance of quality spreads in the credit markets, every one of those lopsidedly tells you that this economy is headed towards real trouble. Now, the question you've asked, Mr. Budget Director, I don't know, whatever it is, whatever the correct, one of the questions you asked is this a correction or is it a bear market? First of all, we don't know. There's an enormous amount of uncertainty, as is obvious. We don't know what the coronavirus means for the Chinese economy, the global economy, and the U.S. economy. I'll get to that in just a second. We simply don't know, and that's really unfortunate. If you looked at the performance of the financial markets, it would say we're headed towards, this is headed towards the end of the current cycle, the end of the bull market, the start of a bear market, and it will be accompanied by a recession. And given the length of the duration of the current economic expansion and bull market, that certainly wouldn't be a surprise to me and shouldn't be a surprise to anybody here. It should be a concern, obviously, to everybody here, because I've mentioned in the past what's the impact on revenues for the state of New York if you're in a period of economic expansion or you're in a period of economic contraction. I did the numbers again. I don't know if they're right. I think they're right. They're pretty close to being right. Again, when I came in here this morning, and it's a fairly significant difference. Roughly the annualized rate of growth in revenues goes from 6% during periods of economic expansion to 0.5% during periods of economic contraction. You might want to spend some time looking hard at those numbers because the possibility of the end of the cycle is shall we say, high or very high. The point being is that I think that The bad news is that the performance of the financial markets is telling you that you really got to, that's why it's going to be so difficult a year. I don't know whether it's going to be a correction or the end of a bear market. There have been 25 corrections since 1890, and there have been approximately 25 bear markets that have been accompanied by recessions. I wish there was a way to tell you ahead of time which it was going to be. I will tell you one thing, one little anecdote, and I know economists will tell you that this is not really useful or may not be useful, but it is useful, is the index of leading economic indicators that's published by the Conference Board has declined in 3 of the last 5 months, or prior to the number we got this month, which was pretty good for the month of January. It's 3 out of 4 months. When you've seen that in financial market history going back to 1960, it's occurred 9 times, and 7 times it's been followed by an economic recession. Jason puts together the yield curve numbers, or at least
Well, I
your
don't
colleagues,
personally, but
your
yes.
colleagues or your associates do. I look at it very carefully. The yield curve is again inverted. I think we all know that. The probability based on, I think, the curve and the way it's going to come out for the month of February is going to be that the probability of a recession starting in 12 months is going to exceed 30%. It's occurred 8 times in the period of 1960 to present. 7 times it's been accompanied by an economic recession. These numbers are starting to add up, and they're starting to say, look, there's a real chance that we could see the end of the bull market and a recession in the upcoming year, even though I hope that Chris's baseline forecast. I don't know what you go with, to tell you the truth, when you're making your revenue forecast. I don't know what you do, but I can only tell you that it's going to be a difficult period and a period of significant uncertainty. Just a couple of numbers. Let's start, I'll just say very briefly with China. My forecast, the forecast of people who work with me, had China at 5.7% growth prior to coronavirus. That's probably going to be between 4 and 5% for this year. The growth rate for China in the first quarter could be as bad as -2%. That's pretty unusual when you're talking about an economy which grew the last 10 years on average over 7%. Global economy, what this means for the global economy is we go from a growth rate of 2.9% to 2.5% or even less. So it's going to have a fairly significant impact on the global economy. My forecast, which is similar to Chris's, not the same, is roughly 1.8%, 1.9% 2020, 2021 for the U.S. economy. If this gets as bad as I think it looks like it might be getting, it's hard for me to believe, but those forecasts, which show a significant slowdown in the economy, will be even lower than that 1.8, 1.9%, and might be in negative territory. So I used to think 1.8, 1.9 was low, but now I'm starting to think, whoa, that might be a little bit on the high side. If I stay with the 1.8, 1.9%, consistent with that number, the number of jobs that are going to be added to payrolls is going to slow. It's going to come down. In the numbers that I showed you in my handout, I show you the consensus forecast, and I show you my forecast. My forecast doesn't make a whole lot of sense to me, to tell you the truth. I would use the consensus forecast. It's a little bit more optimistic, but still consistent with the notion that the economy slows, the growth rate of employment is going to come down. I don't think I'm quite on the same page as Chris. He had a 3.3%, as I recall, unemployment rate. I don't think it's going to get that low. These are just numbers, folks. It's the process of forecasting is very uncertain, but you get the idea. I have it at 3.6% in 2020 and going up, heading up, as you'll see from the table, to roughly 3.7, 3.8%. There's tightness in the labor markets. I also have a little bit of upward pressure on wages at long last, so we should see that. And consistent with the low unemployment rate, the tightness in the labor markets, my judgment is that you're going to see more so than Chris suggested, a slowdown in consumer spending. It's not significantly lower than his numbers, but somewhat lower than his numbers. So 3% in 2018, 2.9%, I think, in 2019, something like 2.2, 2.3% growth rate in 2021. Roughly those numbers. Take a look at them. They'll give you an idea of slowdown in consumer spending. The rate of inflation, I use the Consumer Price Index. I also use the PCE, but using the Consumer Price Index, I have going above 2%, maybe as high as 2.3% in 2020, back down to 2.1% in 2021. In response to this configuration of a slowdown in the economy, I hope, it's just a slowdown in the economy and a little bit of upward pressure on inflation, not significantly so. My guess is the Federal Reserve will leave interest rates unchanged. Given what's gone on, I agree with Chris on this one, and I think I've got it right. Well, I don't know whether I've got it right. I hope I'm consistent with what you said with regard to Federal Reserve policy. My guess is the Federal Reserve, there's always the question, is do the financial markets drive Federal Reserve policy, or does the Federal Reserve drive financial markets? And I don't know what the answer to that question is. It's probably circular, self-fulfilling. My guess is the Federal Reserve will respond by reducing short-term interest rates once, but that's not in my forecast. What's in my forecast is that the Federal Reserve will leave interest rates unchanged as we work through or we move through 2020 and 2021. And that's very, very consistent with, I think, what's a generally accepted or consensus forecast. In regard to interest rates, that means or implies that interest rates will be fairly flat through 2020 and 2021. I agree with you, the long-term interest rates will maybe head up a little bit. That means the curve will steepen a little bit. I'm saying, I'm hoping this. I'm giving it as a forecast, but I'm got my fingers crossed and hoping this is the outcome, because it would be a great outcome compared to what I think the risks are right now. So that's what I think. In the case of stock prices, you're going to be interested to know, maybe interested, that's the silver lining. And I have the numbers, but we went from a period, we have moved, as we ordinarily do move in a bull market, from a period of investment to a period of speculation. We moved from a period which is rational to a period which is less than rational, characterized by leverage, overvaluation, and a high level of optimism. Optimism that starts with optimism that moves into sort of exuberance, which may, if it lasts long enough, move into euphoria. We have, in 2019, in my judgment, moved from a period of investment, which was rational, to a period which is less than rational, or a period of speculation. And as I said, characterized initially, importantly, by overvaluation. We were overvalued. We were 7%, as I do the numbers. Everybody does the numbers differently. I do the numbers. We're about 7% overvalued before coronavirus. The good news, if this can be considered good news, is we're now, according to my calculation, 2.2% undervalued with an upside potential of 5.4% between now and year end, assuming that the baseline forecast is correct. I will only add just an anecdote, something to think about, that's important, is that while this has occurred, while the worries about coronavirus have occurred, forecasts for earnings, I know Chris has talked about the 12% number, and that's a very interesting input. But the forecast for earnings for the S&P 500 have plummeted. And so it's not just the case that concerns or worries showing up in the financial markets. The financial markets send us this message to be very, very concerned. They're showing up in part for a rational reason, or they show up because there is a broad, widespread reduction in earnings estimates for the S&P 500, and that's a little bit troubling. But nevertheless, as I do the numbers, using the baseline forecast, we've gone from being overvalued to being modestly undervalued with some upside potential, and it's been a long time since I've seen that. So to some extent, I think that says, and I say this with fingers crossed, that this is a correction, not the start of a bear market. This is a correction where we'll move from being overvalued to being undervalued. In other words, it represents something as an opportunity for investors. But I don't know. I don't know yet, because I just don't know the extent of the impact on China, on the global economy, and the U.S. economy, and I don't know if anybody really knows that. We can all make a guess. I think Chris has done a great job in summarizing the importance of it. That's kind of it. And I think that, as I say, if you looked at Chris's baseline forecast or his forecast for the outcome for 2020-21, it's great. If you look at mine, I didn't think it was great, 1.8, 1.9%, but now I think it's great. And the problem is I've looked at the financial markets for the last 5 to 7 days, and the financial markets are telling me very clearly, Hugh, wake up. This could be the end of the cycle, which makes your job extremely difficult. I don't know what I'd do.
Thank you, Hugh. Thank you for that. I'm not sure either, based on what you just said, which way to go. But that's the challenge that we have before us. Jason Brem?
Hi, good afternoon. Thank you for inviting me. Delighted to be here on this lovely windy day. So I'm going to talk about the regional economy. Let me start by saying that the views that I express are mine and not necessarily those of the Federal Reserve Bank of New York or the Federal Reserve System. Also, I'm very happy that Hugh and Chris had a lot to say about Fed policy and had forecasts, because that's two things I'm not going to talk about. But I'm going to kind of give you an overview of the sort of emerging trends that are going on across New York State. And of course, I'll be happy to take questions later. Let me start off with, on page 2 here of this presentation, with these maps. So the first map is of the US, and the states are categorized into sort of how they've done over the past year in terms of employment trends, the sort of deep red states. By the way, this isn't like a red state, blue state thing, so let's call them brown states. So the brown states have declined in employment, have seen outright declines. The sort of salmon-colored states have seen very, very modest increases, less than the national average. And then the lighter and darker blue states are the top performing states in terms of job growth. And you can see that New York State happily is in that top category. And it's also interesting to note that, if you look at some of the weaker areas around the country, where you see it is in the sort of manufacturing and farm states, you've seen some weakness. And that sort of reflects the slump that there's been in the manufacturing sector. The second map is sort of the same thing, but instead of over the past year, it's over the past, basically over the past decade. It's since the previous peak, so how things were looking right before the last recession to now. So have they fully recovered? How much more have they grown? In this case, the brown states, again, are states that are still below where they were before the recession. The lighter brown ones are ones that have just barely made it back, and then, of course, the dark bluer states, which New York is in a minority, at least in the Northeast, are in the top category. We've seen actually quite substantial growth, so we've recovered all the jobs and then some from the recession. A couple charts I'm going to show to start off here. So we're going to now drill down to the region a bit, focus on our own proprietary, well, not proprietary, our own surveys of businesses that we do every month. One of them is the Empire State Manufacturing Survey. That's pretty self-explanatory. We also have one called the Business Leader Survey, which is actually a bigger survey of service firms. They're mostly in New York State, but they're covered in our whole district, which also includes northern New Jersey and Fairfield County, Connecticut. And what the index is it's a diffusion index, which, if it's above 0, and the extent to which it's above 0 reflects how much positive responses exceed negative responses. So if businesses are giving us net positive responses, you're going to get higher readings and readings above 0. And so we show a sort of how it's done over this whole past cycle. And you can see that for a while the indexes were getting pretty low. So the second half of last year, our Empire State Manufacturing Survey was hovering around 0, and a couple months actually below 0. And our service sector survey toward the end of the year got quite low as well. And this caused a good bit of concern as for the region. What we've seen in February is a bit of an upswing in this, I won't even call it sentiment, but basically what businesses are telling us that's what's happening right now. That would be pretty encouraging, except that the survey window sort of preceded the recent episode of financial volatility and the sort of coronavirus, the increasingly bad news we've had on the coronavirus. So that, obviously, we're looking with great interest at what our March survey will show. But at least it's a little bit encouraging that you had an uptick in February here. Going to the next chart is when we ask businesses, what do you expect things to do in the next 6 months? So this is sort of their expectations. Those had also gotten pretty low, but the service sector, again, has bounced back quite a bit, and the manufacturing sector has bounced back a little. And it's important what businesses think about the future, because that can determine how much they're building inventories and how much they're investing in capital and what their hiring plans are. Having said that, the optimism has rebounded, but it's not that high. And once again, this also, again, predates the real concern about the news we've had basically in the last 2 weeks about the coronavirus, as well as the financial volatility. So, this is somewhat encouraging, but not as encouraging given the recent developments. Turning to sort of the labor market, this is sort of reflects what everyone on this panel, I think, is seeing, is both at the national level in New York and pretty much everywhere, we've seen unemployment rates at or near record lows. This is not really news. It's encouraging. What it does mean, though, is that you have a lot of businesses, and we hear this anecdotally, that are telling us, look, we'd be hiring more, but we literally can't find qualified people to fill the jobs. So that obviously puts a little bit of a damper on businesses who are looking, for example, to expand or, just need more people. This is, by the way, it's not a bad thing. It's something that's associated with this kind of market, labor market. And then what's interesting is labor force participation, though, has come back a little bit at the national level. Not really so much in New York City and New York State. Not really sure why. New York City, when national labor force participation over the past decade was falling nationally, and in New Jersey, and even in most of New York State, it was not falling in New York City. It was kind of gradually moving up from what has historically been a sort of structurally low level. So basically, labor force participation is, in New York State and in New York City lately has not been much of a factor one way or the other. It's been kind of stable. Oops, sorry. Now, we're looking at payroll employment trends. This is based on place of work. It's a slightly different measure than the unemployment rate. What this is, all right, these charts are a little bit complicated, so let me explain what they are. The light gray lines for each of these geographies we're showing are the official New York Labor Department or Bureau of Labor Statistics, really the same thing, estimates of total employment as they stand. I apologize, the gray line is not that easy to see, but hopefully you can see it there. And then the darker blue line is what we call our early benchmark estimate. So what we do, and I think I probably showed this to you last year, but just to clarify this, every March, the government sort of trues up the employment numbers. The employment numbers are done based on a survey, but we have lagging data, which are much, much more complete from the quarterly census of employment and wages, which you get from unemployment insurance forms. And as these numbers come out, which are about 6 months behind, you get a sense of which way the numbers are going to be revised come March. And so what we decided to do a couple of years ago, and some other Federal Reserve banks have done this, is to actually come up with numerical estimates of what the revisions will look like. So that's basically what the blue line is. The blue line is essentially our forecast. So I guess when I said I don't do any forecast, this is sort of a forecast. But this is a forecast of what we think the revision will look at, and the revisions will come out within the next few weeks from New York State. So the good news is that for New York State, the revisions, and they go back about a year and a half, but mostly for the past year, are going to be upwards, but most of the upward revisions comes in the early part of the period, so in 2018. What we're seeing is sort of an upward shift in the level for 2019. But now going around the region, it gets a little more interesting. So what we see in upstate New York is that growth actually doesn't look as robust as was indicated in the preliminary numbers. So we expect that to be revised down a bit. I'll even get into a little more detail in a minute. New York City, we have somewhat of an upward revision. So New York City's been the sort of the leader of growth, and it's even stronger than it's been looking. And in fact, some of what looked like a slowdown during 2019 looks like it might get revised away. Without getting too technical, there's some issues with the measurement of government employment in New York City, that may overstate this a little bit, but even taking those into account, things look like they're going to be revised to look a little stronger. So New York City really remains the leader, and to a large extent, the only part of New York State that's really had much significant job creation, as we'll see in the next few charts. Long Island had been looking pretty good. We expect that to be revised down a bit. The lower Hudson Valley, we expect to be revised up a little bit. Dutchess Putnam, we expect to be revised down. But I think the key things is that if you look sort of over the past year, employment is kind of flat in most of these areas. I hope this isn't too much local detail, but I think I'm just going to sort of breeze through here. Albany here, Syracuse, we expect a bit of a downward revision. Rochester and Buffalo, we see kind of holding up. You're seeing a little bit of job growth. Rochester and even Syracuse, I think, seem to be the two parts of the state in upstate that are doing fairly well. Albany's doing reasonably well. Albany has been a leader through this past expansion, thanks to the, what do we call the nanotechnology, sorry, and other industries. And then these other areas, some of the smaller areas look like they're, except for Binghamton, which is a little bit encouraging because Binghamton's been very weak, but a lot of the upstate areas look like they're not quite as strong as they had been looking. So a lot of the sort of slowdown in job growth that we're seeing nationally, we're seeing in parts of upstate New York, but not so much in New York City. This next chart, which says total employment, is what we call a spider chart. This is based on our early benchmark, so this will be consistent with the dark blue lines I've been showing you for all these areas. Just to highlight New York City, these are all indexed to the beginning of the recession, so you can kind of see where things stand on a comparable scale. And once again, you see the New York City just sort of having what is a record boom. When I say record, at least going back since the data started about 50 years ago. And what's really impressive is that it's doing it without help from Wall Street, and I'll talk about that in a minute. New York State as a whole is this sort of gold-colored line, and you can imagine if you took New York City out of it, it would probably be a bit below the nation, probably looking more like New Jersey. So once again, New York City has really been the engine of growth for the state. Now, the next chart, which you've probably seen, I like to show this every time, is just a relationship between securities industry, in other words, Wall Street employment, and employment in everything else for the city, so sort of total employment without securities is the gold line. They're scaled differently, obviously. One is scaled to the left, one is scaled to the right. And really two things to note. First, there are big upturns and downturns in the securities industry, which is the blue line, and those are highlighted by the shaded areas. And the turning points and the cycles in the securities industry have historically been followed by turning points and cycles in New York City's overall economy. And so in every case, you can see when securities industry employment starts to turn down, sure enough, within a year or so, usually, total employment and employment excluding securities starts to go down too, and same thing on the upside. What we saw in the last recession is that they kind of turned down around the same time, but total employment didn't go down nearly as much as financial employment. And again, this sort of underscores what I had mentioned before, is that New York City's had this record boom without really any help from the securities industry, at least directly in terms of job creation. And so that would lead to the obvious question, if Wall Street's not driving it, what else is? And the answer is pretty much everything else. A lot of the industries that are driving it are lower wage industries. I mean, pretty much everything is a lower wage industry than the securities industry. But one of the encouraging things that we've been looking at, and I keep expecting this to sort of tail off, and it hasn't done it, is what we call the technology, the information technology sector. It's not an easy sector to measure because you can't go to the employment data. There's no technology category, so you have to kind of cobble it together. And without listing them all, they're listed here, what we include as technology. But it would include companies like Google and Uber and Etsy and some business-to-business firms and also computer manufacturers that obviously don't do much manufacturing in New York City, but they still have a presence in New York City. So these are actually on the same scale. So you can see securities industry employment historically has been much higher than tech employment. But what's happened is tech employment wasn't really hit hard by the recession, and it's doubled essentially since the end of the recession. And even though it's a small sector and big percentage growth in a small sector doesn't usually add up to that much, when you double even a small sector, you get numbers like 86,000 jobs. And this only, by the way, goes up to middle of last year because it's a level of detail that's not available quite as currently. But you can see that it's basically caught up to the securities employment, and it's been a driver of growth. And we'll have people ask, is New York City now like Silicon Valley or Seattle in terms of its dependence on tech employment? No, it's still a fairly small proportion of employment, but it's been a pretty large proportion of job creation. All right, I'm going to switch gears again a little bit, talk a little bit about the surveys, the business surveys that I discussed a little while ago. What we do is every couple months we ask what we call supplementary questions. And the questions we asked in December were very interesting because everyone's concerned about wages. So we just asked companies, what did your wages do last year, and what do you expect them to do this year? And by wages, what we said is like for a similar person in a similar job. So if a company's adding a lot of jobs at the high end or the low end, we don't want that to interfere with the trends. So you can see that historically, going back over the past decade or so, it had been running around 2%, it got up above 3%, and in the last couple of years, it's gotten up to around 4%. This is, again, what people say. This isn't official, taking all companies in the region. It's sort of a snapshot of the firms we survey. And it's also firms, mostly in New York State, but throughout the New York, New Jersey, and part of Connecticut region. And these are service sector firms. Now, when you look at manufacturing firms, you see kind of a similar trend, although it's kind of come down a little bit over the past year. Now, one of the things, it's encouraging that wage growth by this measure and by other measures is higher than it was, say, a few years ago. But, given the tightness of the labor market, one might have expected, more wage growth than we're seeing. So, this is something that obviously we're looking at. It's a component of, when you're looking at inflation, one thing you look at is wages, both for the point of view of how real living standards are changing, but if you do get rapid wage growth or very slow wage growth, it can actually affect inflation. And so given that, inflation has been, at or below our target, we're certainly not concerned about wage growth at this point, and we'd kind of like to see, again, we being me, but I think people would like to see stronger wage growth. But anyway, we're seeing at least, 3.5%, 4% growth, which is at least a bit above the inflation rate. On the subject of wages, I just want to quickly breeze through these next charts. I don't know if some of you may have seen it. We did a blog post last year on the minimum wage, and what motivated it was the fact that New York has ratcheted up its minimum wage, pretty significantly, even in upstate New York, where it's gone up more slowly than in New York City. And you have this very big border geographic region of the New York-Pennsylvania border, where on one side of the border you have minimum wage going up from 7.25 to 8 to 9 to 10 to 11, and the other side of the border it's been remained at 7.25, which is the national minimum wage. Now there are other issues for fast food tip workers, which there's a table. I'm not really going to get into it, but we thought this would make for a good natural experiment, like what has this divergence in minimum wage in two very adjacent regions done. So what we did was going ahead two slides, we first looked at an industry which is leisure and hospitality, which tends to be an industry with a lot of lower paid workers, so you would expect the minimum wage effects to be significant there. So we wanted to see, did this have any adverse employment effect? Because economic theory would suggest that when you start constraining decisions about employment using minimum wages, it might have the effect of lowering employment. We actually didn't see that. We saw actually a bit of an increase in New York. That was in part due to a couple casinos opening. If you take narrower definitions of the industry, such as restaurants or full-service restaurants or other, you pretty much get lines that are like right in line. So it seems to have had no effect, positive or negative, on employment. It has had an effect on, I shouldn't say it's had an effect. We have seen a divergence in average weekly earnings, which is what you would expect in a low-wage industry when the minimum wage is going up. So, that is, the latter thing is not surprising. We also looked at retail trade because we thought, well, the leisure and hospitality is a growing industry. Retail's a shrinking industry, at least lately. Has there been any divergence in the retail trade sector? And again, in terms of employment, you kind of see the lines go side by side. There doesn't seem to have been any divergence. And again, you can see the wages going up more. Now, I just want to preface this or add to this that this is only two sectors. It's what's happened so far. And it doesn't mean that there aren't other effects. So, for example, we've talked to people, and they say it's harder for a small entrepreneur to open a business in a low-wage industry. We've heard that it's hard for manufacturers to compete with companies in places like Alabama and Asia when the minimum wage is going up. These are things that we're actually working on research currently that to get a more in-depth look at what's happened and with continuing increases in the minimum wage. So we're kind of interested to see what that's going to show, but I don't have any results for that yet. Last but not least, I want to say a few things about home prices. We use this, what we call CoreLogic Home Price Index, which is based on repeat sales. So it basically attempts to measure what a similar home would sell for on average in one period versus the next period versus the next period. You can see in New York State, you see the sort of the dip, slump after the recession and housing. I would call it a debacle, but in New York State, it wasn't quite as much of a debacle, but it was certainly a downturn. And you've seen it's come back, and what you've seen is in upstate New York, at least especially in the last couple of years, it's done a lot. You've seen a lot more home price appreciation than you have in the New York City metro area. Second page, a little more detail. You can see places like Buffalo and Rochester have, seen actually an acceleration in home prices. Albany, you've seen some pretty good growth. So this is what's going on upstate. You get into the closer to New York City, the New York metro area, you see this flattening out. Kingston, we consider it upstate, I don't know. A lot of New Yorkers consider Westchester upstate, so I don't want to get into that discussion. But we define Kingston as upstate. Dutchess Putnam, I think we define as downstate. But you can see that those areas are, you see no sort of change in the trend in home prices. Where you do see a change in the trend, where you do see a change in the trend, interestingly, is literally in New York City and to some extent in Long Island. So Queens, you do see this little uptick in the last month, but you can see that home prices have sort of leveled off. Growth has slowed a little bit in Long Island, and then the most sort of high-priced markets, Manhattan and Brooklyn, which had been, very, very strong, both in terms of level and in terms of growth, have definitely seen some weakening in prices. And so you're probably thinking, is this because of the SALT changes? Because that's where you would expect to see the most change. And my answer is that, there are a lot of factors that affect home prices. There's housing affordability. There's, renting versus owning, how the ratios are. It is, though, a little bit surprising that in the one area that you've seen the strongest job growth, you've seen the biggest slowing in home price growth. And I'll just finish up by mentioning, I don't have information on it here. It's on our blog. I can send you. But some of my colleagues actually did do some analysis of I don't remember if it's by county or zip code or what, but they kind of looked at different parts of New York State, what's happening with home prices in areas that are with a large proportion of the population itemizes versus less. And there does seem to be a correlation, that is, in areas where larger proportions of the population itemize, I think there's been more of a slowing in home prices. I didn't actually work on this particular paper, but it's something you can look at on our blog. So I'll just finish there to leave time for my colleague here. I won't read you the recap, but it's here in writing if you want to look at it. Thank you very much.
Thank you very much, Mr. Brown. Mr. Kajal-Lahiri?
Thank you, Rob, Mohika, and the leading members of the Senate and Assembly. Thanks for inviting me. Because I saw my name at the end, I took the opportunity of predicting what they'll be reporting. So in my presentation, precisely have excluded all those, I must say, so such that I don't repeat myself. Now, however, I'll repeat something for our own understanding. As I see, what we are trying to do here is revenue forecasting on a fiscal year basis. That's what we are into. And the whole issue is, how does the economy, say New York City economy and the US economy, can affect us? I mean, that's what we are talking about here, right? And there are hundreds and thousands of variables out there. Many of them we touched in today. But at the end of the day, we have to ask how each of developments, some are going up, some are going down, in the aggregate, how they are going to affect our fiscal year tax revenue at certain horizons. The budget negotiation begins 18 months before. That's where you have to begin forecasting. And the major part is like end of March. But given that information today, you have to do the best forecast you can do today, right? Even though we know, the coronavirus is looming in the back, but there's nothing much we can do about it right now. We know nothing about it. So we have to forecast conditional on what we know right now. And then, of course, after 1 month or mid-year budget, this thing, you would have ample time to adjust your forecast, because state revenues, state budgets have to be balanced, unlike federal budget. You cannot print money. So that's the challenge of state revenue forecasting, right? That the federal government does not face, that you have to balance by the end of the year, right? That's the challenging. So in that, so in terms of, moving parts, I've been thinking about this for quite some time, what's the way to do this? And as I can see that the frequency at which you have to forecast is much shorter than the year-over-year growth that you have to do. So the data comes on a weekly basis, on a monthly basis. So the whole issue is, as the new data comes in, how the new information gets reflected in your continual forecast for the budget. Right? This is the business we are in. And I have not seen any model which actually tries to do that, okay? The fact is that hundreds of variables, thousands of variables out there, and these days with the machine learning algorithms, boosting, and lasso and so on, you can really bring in hundreds of variables and ask, how do they affect, say, year-over-year growth in revenue forecasting, right? So in that sense, we built a model in SUNY Albany. Many of our students and old colleagues are here using many of their help. Is actually 3 moving parts. One is the US economy. We talked about a lot of those variables. The question is how thousands of those variables can possibly affect New York State revenue. That's the first question. Second is New York State. New York State cycles are not the same as the US economic cycles. I have some graphs there I can show you, okay? So there are hundreds of variables that depict New York State economy. Some of them Jason covered, right? So the question is, and another thing, how all these variables can affect New York State revenue. And then at the end of the day, you have the New York State revenue are the taxes that you know every month, the things coming in, and sometimes they surprise you, sometimes they go well. But we know one thing, that the revenue forecast errors, everybody knows that, creates havoc during recession. That's where we go wrong, right? Non-recession years, I think all of us are okay. So the question is then, how do you incorporate recession predictions in your budget forecasting? That's a key, I think, ingredient that has to be brought in, okay? So we have a model where these three things come in, and we do a year-over-year budget forecasting. And I just quickly go through some of the pros and cons right now that we see in other indicators. One starts with consumer confidence. As you know, it's an all-time high, right? The intriguing part is that unlike in other years, say your real disposable per capita income or retail sales are not at par with the solid gains in consumer sentiment that we've been getting. That's an intriguing thing this time, okay? One has to be careful why it is not. Then, the jobs, as many of our colleagues have covered, they're plentiful. Unemployment rate is really, really low. So those must reflect in our budget forecasting, right? That's good. But one thing that I may like to emphasize is this. Whenever you talk about this forecast, say from Blue Chip or whatever forecast we have, question is, what is the underlying uncertainty in this forecast? Unless we know the uncertainty, of 2% growth, we cannot really make decisions. So I have plotted on the third page the uncertainty of GDP forecast, 4 quarters ahead. First thing is that as you go 2 years ahead, the uncertainty gets so big, really, you cannot say anything very meaningfully, in my mind, okay? Whether the recession probability or GDP growth and so on. 2 years ahead, 3 years ahead, information is flat. Now, if you look at the uncertainty of GDP forecast, it's almost like a 1% variance you got out of a growth rate of 2%. So you can easily cover a 95% confidence with the 0%. You run that risk all the time. So no matter what we say, we have to accept the uncertainty with which these numbers come. Otherwise, we will be lying to ourselves if we don't recognize the underlying uncertainty. There is no crystal ball out there, okay? Now, I have plotted some of the probability distribution, density forecast, in terms of rather than saying 2%, you ask how people assign probabilities of not 2%, but say 1%. What's the possibility that will be negative 1%, right? And in some of the graphs, if you see on the third page, you can see that a significant part of the probability is to the left of 0. That means 15 to 20% of the probability people are saying it could be a negative GDP, even this year. Of course, there's not much left, but people live with those probabilities. It is never 0, okay? So we have to accept that, and my point is that the uncertainty of these forecasts are pretty formidable, pretty big, and we have to realize. There's another thing is, the current probability of recession. The fact is that, New York State has leading indicators. We need to go and see what is out there. Federal Reserve Philadelphia actually produces a leading indicator for New York State. If you run that leading indicators in a probability model, you don't see much probability of a recession right now. You can look at it's around, say, 10, 20%. So it's not much. It has to be much higher for you to take significantly that a recession is coming next year. It's not there. But that is not to say that, coronavirus can hit us very badly in 2 weeks' time, and the life would change, right? But as of now, you don't see much probability in the current fiscal year that there'd be recession. But then after the election is over, say post-November, what would happen is a different matter. For example, right now, we are in an overstimulative state of the economy. The fiscal policies of the federal government are stimulative. The Federal Reserve has reduced federal funds 2-3 times, right? But so even if the coronavirus comes, it would be a supply shock. It won't be a demand shock, right? And so by reducing the federal funds at that point, I doubt if it's going to do anything. Also, I heard a lot of people saying that there would be a lowering of the federal funds rate 2-3 months down the road. And the market has already taken that into their consideration. The market knows that there would be a reduction in the federal funds rate, not next month, maybe the next federal funds report. And the market has already reflected. So it won't be done in November, it's too close to election, but somewhere there'd be a correction. And that there'd be a correction, but the market, you don't need to worry about it. Market has already incorporated the information in their forecast. Now, I have another probability of recession, say 6 months ahead. Again, you don't see much probability of a recession. And another thing I try to draw your attention is an index which has become very, an uncertainty index, as a lot of economists are paying attention, and that's called Policy Uncertainty Index. That is, as the government at the federal level worry about a lot of policy changes, the policy uncertainty changes. And if you look at the blue graph, you see that there's a huge amount of policy uncertainty that a lot of people are giving out there. And now there's a proof that policy uncertainty affects the economy negatively. It's not good for the economy. So that is lurking in the background, this huge uncertainty with which you're living these days, that it is in the background that is affecting the economy badly, okay? We have to consider that also. Now, also I talked about US factor, New York factor. I've given some, I've extracted one factor from hundreds of US variables, and it's called under US factor. You see that the US factor goes up and down with the US recession pretty well. But if you look at the New York factor, it doesn't behave exactly the same way as the US factor. So it has its own dynamics. And that generates a different dynamics for our tax collection. So the tax revenue has another cycle. I did that over a long period of time using monthly data. And you see that the New York State revenue cycles moves around quite a bit, a lot more than, say, a standard US factor. So when you forecast this, you have to consider that in account that there's a huge variation, month-to-month variation in New York State revenue forecast, okay? Revenues. Finally, if I may go back to certain things that Senator Krueger was saying, is that how you think the coronavirus is going to affect our economy, right? One thing is that if, in my estimation, my frequent trips to China for many, many years, I think if one country can contain virus more than anybody, it's China. You know, it's a regimented country. People are living within their homes, actually, okay, right now. They're not coming out. So my hope is that they will be able to control this better than anybody. Second good news is that if you look at, even if it comes out and it affects USA, shores of USA, New York State, if you look at our total amount of export-import we do with China, New York State is a state which has very little in terms of relations with China. There are West Coast states like California, Washington, Southeast states like South Carolina, those are a lot more vulnerable to slackening in China than New York State. Okay, we have hardly 2.5% of our trade that goes with China. Of course, that's the first round of effect. Then it would affect everybody. So the immediate impact, I don't think, would affect New York that much, as it can affect many other states in the United States. I think I have certain forecasts. I didn't share that with you because for us to upgrade our forecast every month is a real pain because you have more than 500 variables that you have to collect, update, deserialize each of them, and then run through the model. But if I could really help, I'd be able to share the dynamics of the models and what it is saying in terms of next year and year after, revenue forecast. Thank you very much.
Thank you very much, Mr. Lahiri. Do we have any questions from the panelists? No questions? Senator Stewart?
Yes, I just had three questions. First, for Mr. Brahm. I was intrigued by your analysis in terms of the impact on the minimum wage differential in the counties that border New York and Pennsylvania. You mentioned in the charts that say earnings rose more in New York than Pennsylvania counties with no adverse employment effects. But you also cited the fact that there have been casinos established. Is that in conjunction with this?
Wait, I'm sorry, could you say that last part? The what is that?
With casinos opening
Oh, casinos,
in
yeah.
this other tier. Do you have an analysis in terms of impact on employment without the casinos, if you take those out?
Yeah, we looked at it. I don't have it in here. We didn't put it in the post. But so one way to, we wanted to be consistent in defining sectors. So leisure and hospitality is sort of what would they call a super sector. You can also take a component of that, which is restaurants and bars. If you did a similar chart for that, for restaurants and bars, which would not include casinos, it would show them pretty much lining up very evenly in terms of employment, and you still see almost as much of a divergence in earnings. You can also look at full-service restaurants, this is what we think of as robustness checks. We're like, if we do it this way, do you get a similar weighting? If you do it that way, and so yeah, we do. I can send you the charts that we have that we didn't publish that include any of those subsectors if you'd like.
Okay, just curious on
Yeah,
that.
sure. It's a good question.
For anyone who would like to respond to this, we have seen, particularly in the upstate region, some out-migration of population. I think that according to the Census Bureau, I think it was about 80,000 even just last year. How does this out-migration dynamic that we've seen over the last number of years, particularly in upstate New York, how does that impact the labor participation rate as well as the unemployment rate? And how should we be factoring any of this in terms of forecasting going forward?
Well, let me start off, and I'm sure my colleagues may have something to add. I think so keep in mind first that the annual population estimates are estimates, and they don't always, you'll get times when the census comes out in 2020, this year, next year, and shows a little bit of a different picture than these preliminary population estimates. So these are not numbers that are like hard, very precise numbers. And the fact, again, and I'll give you just one very brief example that leads me to be a little bit, I wouldn't even call it skeptical, but not to take these numbers as fact, is that last decade, we found that Puerto Rico, which is also part of our district, the population had been growing based on these population estimates, and the census came out and it showed a downturn. And so it can go either way. So I'll just start out by mentioning that. The other thing is, in a lot of the upstate areas, it's curious that home prices have continued to go up, that there's sort of this excess demand for housing in a situation where apparently there's this out-migration, especially, I've heard anecdotally, more at the high end of the income spectrum, and it's hard it's a little bit hard to reconcile that. So I guess my response is I would like to wait for the 2020 census to come out before jumping to any conclusions about that. But I leave this open.
Sometimes this comes down to just numbers. I'm not sure exactly what you're getting at, but a lot of the times, a lot of numbers we've seen more recently from each of the states in New England is that we've seen significant declines in the unemployment rate, and everybody's applauded that. but it's been largely because simply the outflow of jobs. So the labor force has declined in many of the states, particularly in a place like Vermont. I'd only add couple small anecdotes, which are just not anecdotes, but interesting, and some of this has been referred to more recently, is that the principal reason growth has been so terrible for the U.S. as a whole, or at least compared to other recoveries prior to the start of the 2009 recovery, is the growth rate of the population has slowed. The growth rate of the labor force has slowed. The participation rate has come down. And importantly, when we get to gross state product or gross domestic product, productivity has grown, but it's grown at a very slow pace. But, and this is encouraging, and you're looking for something encouraging, especially when we're talking about 1.8, 1.9% growth, we're starting to see a growth in the labor force, growth in participation, particularly among women. Well, I think this was also mentioned by, maybe it was Chris, but the growth rate and the participation rate, and also growth or recovery in productivity. I think I've mentioned it in my write-up. I'm pretty optimistic. I'm on the optimistic side on productivity. I think productivity, when we start to see some of the payoffs to things like artificial intelligence start to kick in, we're going to start to see, I think, really positive, it doesn't happen right away, but real stronger growth in productivity. That's really good news for the national economy and the New York State economy. The women coming back into the labor force is pretty interesting. And well, I'll just leave it at that. They've gone from being caregivers to, and the tightness in the labor markets are largely being helped significantly by women, and especially very qualified women. These are highly educated, qualified women who should really work in this environment, are coming back into the labor force and getting jobs.
If I may add,
It's important.
that actually with a lot of out-migration, you may expect that actually the unemployment rate can go lower because people are leaving, and this unemployment is computed by household surveys. They ask, are you looking for a job? And you have a job, right? So if the economy stays the same and a lot of people have left, you have more jobs left in the economy and lesser people. So that way it can affect. But it's an interesting question. At the end, how it affects, I don't think nobody has studied at the micro level. It would be interesting to look at it, actually.
I just want to add also that I think a big part of the outmigration is most likely due to simply population aging. That is, people get to the point where they retire and they want to move someplace warmer, and they go. So until we get the census numbers, I think will give us a much better read on how much is simply due to population aging.
Well, it's important that we count everyone in the census. My final question is for Professor Lahiri. You mentioned, if I understood you correctly, that there are differences when we're looking at the U.S. economy versus New York State and conditions here in New York State. In terms of the economy, state of the economy, as well as, revenues, tax revenues. Cycles, yeah, different. Would you say, do we lag behind, in terms of responding differently here in New York to economic ups and downs nationally, or just?
Actually, it depends.
Or if you could just
Yeah.
explore that just a bit.
We have looked at it. It depends. It's not always that the U.S. New York economy lags behind, because sometimes it used to happen is when a New York economy falls due to Wall Street, so the New York State ahead of the, you see, so one has to really monitor this very carefully. It can sort of not follow the same lead-lag relationship, actually, but the cycles are different. The similarity, of course, is there, but they're not exactly same.
Thank you.
Thank you. Do we have any other questions from the panel?
I just want to throw in one thing, since my colleague here brought up the issue of migration and the population going down, and I agree. I think the numbers do reflect older people choose warmer climates, but it's also really, it's the question of inward migration as well as outward, because we've had a reduction in immigration. And so New York State's strength has always been a new generation of new populations from all over the world coming, strengthening, expanding us. And I believe that the numbers reflect that we have seen a significant drop in immigration to New York because of our changing federal policies. And so I think you have to look at both of those together.
Thank you, Senator Krueger. Senator Manwara?
Thank you for your presentations. I just want to ask about a couple, and, you know, these are generally to the panel, about a couple of different issues. One of which, so going back to SALT and the changes at the federal level, I think, I mean, I'm a representative from Long Island, so I know very well, you know, the impact that has had, but I think we have a tendency in New York to talk about just SALT and not, you know, acknowledge that there were more wide-ranging changes to the tax code made as a result of that act. You know, lowering rates, the standard deduction changes, some of the other things, child tax credits, all those different things. So, you know, when we look at the overall impact, I think those need to be taken into account as well. And I know, again, from the Long Island perspective, and certainly regionally, there are more impacts on the SALT side. But you know, what has been on the positive side in other parts of the state, or you know, downstate as well, from those more wide-ranging changes?
So obviously, yes, you're right. There are a lot of different forces affecting it. I think what the SALT change did, it wasn't, so one thing that it does is change the relationship between the advantages of owning versus renting. In other words, one of the advantages typically when you're weighing, you know, for those people at the margin, whether you're going to rent or buy a place, is, you know, how much does it cost? And, you know, a big part of that is the tax deduction that you get on buying. So if you change that equation, what you would expect to see in a sense, especially in a place where a lot of people have deductions like Long Island and New York City, is to have maybe an adverse effect on prices on the sales market and an upward effect on rentals. And anecdotally, that's exactly what we've seen in New York City. So in New York City and probably in Long Island, what we've seen is the rental market has been going strong. There are low vacancy rates, rents going up. The rent is too damn high. It was how long ago? But it's been going up, and so. To an extent, you know, what you might expect happen is to have this level shift, and then you get back to this new equilibrium. And again, you know, people who are dead set on owning their place will buy. People who are dead set on renting are going to rent, and then those people who are like weighing the two will sort of the prices and rents would adjust. That's what you'd expect to happen in theory. So I guess that's my short answer.
Actually, I saw a paper, full-length paper, I'd love to share with you, where they have studied by state this SALT and the others associated, how it has at the end affected, because true, there are a lot of positive and negative. I think I remember that of all states, only New York State and California had a net negative effect. Others were okay. They kind of considered hundreds of different factors that went different ways, and they added, I think it's the NBR paper, which is a pretty respectable paper, that I can share with you if you're interested.
Yeah, please. Sure. And then a couple other questions. In terms of the Fed's involvement, any opinions on what is holding inflation below the target rate? And you know, if it's interest rates that are no longer driving inflation, how can the Fed help reach the target?
I mean, why is inflation below the target, and what is the Federal Reserve? I don't think this is a Federal Reserve issue. I think that, to be honest with you, I think it's one of the big conundrums of the current state of affairs, where we get the employment conditions improving so much, and we don't get upward pressure on prices. The only thing I can come up with, and I'm not even sure this is helpful, is that capacity utilization rates for the U.S. in manufacturing are generally low. They're not up where they used to, or at least traditionally, would put upward pressure on prices. They're low. They're around 77%. They're not up at the 84, 85% level. And I think that's as close as I can come. I really don't know the answer to the question. It has been a big conundrum, I think, for the economics community.
No. I think there are at least four factors that have been contributing to the low inflation. The first is, over the last several years, the dollar has generally been rising, and that reduces import prices in dollars. And since, even though they're imports and not part of GDP, imports are their prices are recorded in these sales deflators, the CPI and the PCE price index. So that's the first factor. Secondly, commodity prices have been weak. The weakness in commodity prices means material costs are low, transportation costs in terms of energy usage are lower, and that also comes through not only in the headline numbers, but also in core. Third, globally, inflation has been soft because partly the slowing in the Chinese economy, but elsewhere. And the fourth factor is that the introduction of Obamacare led to a sharp deceleration in the pace of healthcare prices. And that deceleration, is reflected in the indexes, and it remains to be seen whether, and that was anticipated to be part of a one-time level adjustment, maybe not necessarily a permanent downward ratchet in the rate of growth of healthcare prices. But so far, it seems to have been largely sustained, and that's lowered overall inflation a couple of tenths.
But the inflation targeting also, I mean, around the whole Western hemisphere, I mean, it is around 1.9, that's the targeted inflation rate, that the Federal Reserve, central banks really work on that. So not only USA, if you go whole of Europe, it is less than 2%, actually. It's a worldwide phenomenon that's happening.
And just to bolster what Chris was saying, if you looked at goods versus services inflation, services inflation, I think, is doing more like what it's supposed to do in a sense, whereas it's goods inflation, which sort of confirms the capacity utilization issue, the world trade issue, and the dollar and so forth.
Just one last thing, getting back to, our central duty here in terms of coming up with, a consensus number. Given the volatility and a lot of the factors that you have all presented, would you recommend that we proceed cautiously? Our budget situation, in the past, we've had some situations where deficits have come as a result of, economic downturns and there's tax receipts not being as strong. Right now, we're seeing increases in tax receipts, and that side of it is solid, at least for the short term. But if we, don't proceed cautiously and we allow spending to increase, and then we see that downturn, that's where we can really run into an issue.
You sure can. And that was my message. If you're at the 130-month mark of a bull market, 127th month of an economic expansion, you've got to pay really close attention to what's going on. You could get into trouble. I don't know if you call it a 2% rule or what you would call it, but I wouldn't ignore that. And that really makes a whole lot of sense, to be honest with you. I mean, I think it's, I don't know if it's a hard and fast rule, you'll have to let me know, but does everybody know what I'm talking about? Okay.
I would say that all of the forecasts we have in front of us are somewhat out of date today, and somewhat as a result of what's happening with COVID-19, they're probably overly optimistic. So I would say, use that as a starting point.
Okay, thank you very much. And just on behalf of all the panelists, I really want to thank you for all of your presentations. They'll be very helpful, and we will use them in our deliberations to come up with a consensus revenue forecast. So with that, this will be the end of the forecasting conference. Thank you.